Okay. Share the screen so hopefully everybody can see that. All right, everyone. Well, thanks for joining. So tonight's webinar, I want to talk about cutting deals with borrowers. So this is a subject that gets mentioned now and again at like a very high level when people talk about notes, but I don't really seen too many folks dive into the weeds on exactly how to put these deals together and structure them and some of the different options. So I thought this would be a good topic. I was actually asked to present this at a local investor. It used to be Investor Network of Colorado. They changed the name. It's still INC here. And I presented this last week and it seemed to go over pretty well. In that presentation, there were a lot of folks in there who weren't familiar with notes. So I had some like introductory material in the front of it, which I took out for this because I figure anyone tuning into the webinar is kind of already familiar with the ABCs of notes. So what I'm going to do is go through some case studies of some actual deals. And actually, these are, I think, all in flight right now. So I'm kind of right in the middle of them, and then I'll present the options. And then I didn't get the polls set up on this, but you can kind of think about how you would do it. And then I'll show what I actually did and then what actually happened. Now, of course, the choices that I made aren't necessarily the correct ones. That's just what I did. There are a lot of different ways to put these together and do them, and I don't know that there are any necessarily right or wrong answers, but I'll kind of talk through some of my thought processes, and you guys can feel free to ask questions and things as we go along. I'll try to monitor the chat as best I can. Actually, I've got I had to upgrade my Zoom account to do webinars, and some of the controls are a little bit different, so we'll see how well I do with all of this. So talking about the general framework for what I'm going to talk about. So my specific strategy for non-performing notes, and again, there are a lot of strategies you can pursue, but this is my basic template. Some deals I do them differently, but this is kind of like the bread and butter. But you know, buy at a discount, which actually you're always doing, even if you're buying a performing note, it should be at some sort of a discount. But after you buy the loan and get it boarded, so reach out to the borrower, and I do this through a third-party vendor. I use Polaris counselors for it. I don't do it through the servicer. You can do it through the servicer as well. When I have done it through servicers, I haven't had a great experience, but I've got a vendor I like a lot for doing that. And then hopefully they're able to talk to the borrower and we reach a deal. And then hopefully they perform on that deal, which they don't always do. And then eventually resell a performing loan. And then my fallback plan is always to foreclose. One area of my strategy differs a little from some that do this. There seem to be a lot of folks out there who will try to do this, except if they don't reach a deal with the borrower, they'll just resell the loan to someone else. A lot of the loans they pick up have been passed around a couple of times, but I try not to buy anything that I'm not willing to foreclose on at the time. So if this baseline plan doesn't work for getting it to reperform, then I will absolutely go through the foreclosure. And I think sometimes that helps me get them to reperform as well, because well, I'll get into that a little bit later. Sometimes if the borrower knows that you're going to foreclose and not just resell it, that can help get them. But for the sake of this webinar, we're going to be talking about this area where we actually reach a deal, which again, you know, you see this talked a lot about at a high level where they say, well, you're going to reach out to the borrower and cut a deal, but I don't see too many folks talk about the nuts and bolts of what those actually look like. So there are a lot of decisions that you end up making in this process. And, you know, kind of the first one that's really focused on tonight is, you know, what deals do you offer the borrower? So when I have my loss mitigation folks reach out to the borrower, I give them a lot of information ahead of time. So I give them the information on the loan, the pay history, everything. And then I tell them the outcomes that I'm looking for. And then they use that, they talk to the borrower, see what's going on, and then they get back to me. And then there's a decision of what to accept from the borrower. So there's what I want a lot of times, and then there's what I can credibly get at the same time. And so a lot of times you're essentially getting counter offered And then at what point do you start foreclosure? So like I said, the fallback plan is always to go through foreclosure. And so I'm looking at it from the standpoint of one, all things being equal, I'd really rather keep the borrower in their home for their sake, for one, but two, I don't really like dealing with REOs, even though I deal with them all the time and they're part of the business. And then once you go down the foreclosure route, the uncertainty and the risk factors kick up because we're not seeing the inside of the house when we do our BPOs. We don't know what we're really going to run into. Borrowers can file BK and try to drag things out. So I understand what the return is and I make sure it makes sense to be able to foreclose, but the risk factor shoots up. If we can get them to reinstate, then we have a much more predictable return. I mean, once someone restates and starts paying, I know how much money is going to come in. I kind of know what I'll be able to sell the note for after a certain amount of time. And then cash for keys offers as well. So I get into a little bit of that. Like I said, I don't always want REOs, but if you can get it through cash for keys, that's definitely a more orderly process and your deal can go a whole lot faster. There's nothing, it's really nice when you buy a loan, you do the borrower outreach and they're like, we want to hand the house back. All right, so case one. So this is in Ashtabula, Ohio, and I'll lay out the loan parameters and I'll get into the decisions in a minute. So this one had an unpaid balance of $35,241 and a payoff of a little over $41,000. So they're about $6,000 behind, 21 months behind on the loan, and there had only been one payment in the last 12 months. And they had $1,900 in delinquent taxes owed. So this one is kind of more stale than most of them I buy. So I do like to buy them where there are some payments in the last 12 months, or at least some signs of life, because you can get, if there's some signs of life in the last 12 months, your probability of getting them to reperform goes way, way up. But this one only had one payment in the last 12 months. They're pretty far behind. They're starting to rack up delinquent taxes. So I thought this one had a chance to reperform, but had a pretty high likelihood of foreclosure. But I didn't mind that because the BPO value was really high, 103.5. Now that's, and you can see from the photo here, I mean, the exterior condition looks pretty good. Don't know anything about the inside of the property. And I picked the note up for $17,000, which is about 50% of the unpaid balance, which is kind of normal for this kind of stuff. Usually, pricing is ranging between 40 to 60 cents on the dollar, depending most of the time, assuming it's non-performing. So the possible exits. So I always start by looking at the foreclosure option, because that's my fallback. So the first thing I want to do is look and understand what's my return if I have to take this through foreclosure. And then that provides kind of the basis for how aggressive I want to be in pursuing other types of exits. So we can obviously do a deed in lieu or cash for keys, although in this one looks pretty going in, I figured this was pretty unlikely since the borrower had so much equity in it. I mean, the borrower could just sell the house and pay me off if they really wanted to leave. So I didn't see that as much of an option. And then kind of my go-to is the forbearance agreement with a trial payment plan and then do a loan mod. So the way that I normally structure these is you want some kind of good faith down payment from the borrower, some number of trial payments, 6 to 12. I've been increasingly doing 12 lately. I used to always do 6, and I've been kind of stretching that out a little bit more lately. And then modify the loan. And then usually what I'll do is modify the loan by taking the arrearages and rolling those in to the unpaid balance and then just stretching the term, leaving the P&I and the interest rate the same. Now, obviously, there are a lot of degrees of freedom in how you can mod a loan. This one's just kind of simple because it keeps a lot of the terms the same. And what I like about getting the arrearages rolled into the unpaid balance is, when you're pricing these things, you should always be pricing them based on the unpaid balance, not the payoff amount. But this way, when I process the mod, I'm taking those arrearages and rolling them into the balance. So I'm, not only getting the loan reperforming so I can sell it at a higher percentage, but I'm increasing the unpaid balance at the same time, so you can kind of juice your return by doing that as well. If the borrower wants to put a substantial good faith down payment down and they have a lot of arrearages, then I can do dollar for dollar forgiveness on that if they want to go there. There are a lot of options, but that's kind of the basic framework. One of the big keys, though, is getting a decent good faith down payment so the borrower has some skin in the game. What you don't want to do is have the borrower sign one of these agreements and then later flake out. I've definitely had that happen. But if they put down a sizable good faith down payment, then they know if they don't keep following through, they're still going to get foreclosed on. They're going to lose that good faith down payment. And it also stops a borrower from using a forbearance agreement as a stall tactic, to foreclosure. So if they don't have to put any skin in the game, it's very easy. We reach out to the borrower and you say, do you want to do a forbearance agreement instead of foreclosure? They can just go, oh yeah, sure. And then never quite follow through. So this is what we're looking at. So what I always like to do is start by calculating the foreclosure option, since this is my fallback. So I want to understand what my returns look like in this, because this is really my alternative if the other options fail. So on this one, now this was a contract for deed in Ohio, and it was, they have some special rules for contract for deeds in Ohio where if the borrower is paid more than 5 years on it, then you have to go through the foreclosure, and this one falls in that option. So I'm assuming 14-month timeline, 1 month to get it boarded, because I was leaving it at the same loan servicer, so it makes it easier. 3 months for loss mitigation, about 7 months for the foreclosure process. Mileage varies on that. And then I assume about 3 months on the back end to evict the borrower and sell the home. The back end, once you get the REO back, just always takes longer than I expect. I don't know what it is. Because till you get the borrower out, you get things cleaned out, and get it listed. That always seems to take several weeks. And then, of course, once you list it, it doesn't sell right away. And then even once you get an agreement to sell, it takes a little bit of time before you close. So that 3 months goes by pretty fast most of the time. My all-in costs, I'm assuming $29,000, so $17,000 for the note, and a bunch in legal fees, clean out costs, due diligence, taxes, servicing. The legal fees for Ohio, I think, are about $5,000 to $6,000. I try to be conservative on these because my cleanouts are always bigger and more expensive than what I think. And then the proceeds, about $42,000. Now, even though the BPO value was 103, since I have to go through foreclosure at a sheriff's sale, I'm limited to my payoff amount. So I'm estimating that payoff amount to be about 42. But this comes out to a pretty healthy ROI, which is good. If I'm going into a deal like this one is more likely to be foreclosure than some of my other ones, I want the ROI on the foreclosure to be better. If I'm doing another one where, let's say there are 8 or 9 payments in the last 12 months, I know there's a much higher probability of getting it to reperform, then I'm okay with a slower ROI on the foreclosure option because it's less likely to happen. So somebody raised their hand. Let me see if I can, there we go. Okay. So John, do you have a question? If you unmute, you can just ask. I can try to find the chat too.
When you were talking about time frame to evict and list, do you always go through a realtor to sell, or have you ever tried other methods to sell the REO?
Yeah, I've tried other methods as well. I've listed stuff on Craigslist, and there are some other websites I've listed on. I think is it Hubzu and something else. And a couple times I've had offers from like Craigslist borrowers, or buyers, but they never seem to close. It seems like all the ones that I close seem to go through realtors. I don't like that because it's expensive. And, when you go through title companies and stuff, there's a lot of fees. I actually just got one in the mail today of one that I'm closing out. I'm never happy with what that ends up costing, but it seems to be the most reliable way to get rid of them. So.
Okay. Appreciate it.
Yep, no problem. Let me just check if there's. Okay, in the chat. All right, so case one, so the cash for keys options. The first question is, what would we offer for cash for keys? So we could just not offer anything, which isn't unreasonable because the borrower is unlikely to take it, you know, all the way up to 10,000 plus because our BPO value is pretty high. So I didn't get the polls set up ahead of time. So if you guys want, you can put something in the chat or just think amongst yourselves how you would, you know, what you might offer for cash for keys. So what I'll do is I'll lay out the cash for keys options, the forbearance agreements options, and then I'll show you what I did. All right. So, and then for the forbearance trial payment plan, we got to decide how much of a good faith down payment we want to require, how many trial payments, and then the trial payment plan amount. And remember, right, this is what we're giving to the borrower outreach people before they go and talk to the borrower. In some cases, you know, I run through these exercises and they can't even find the borrower. So I gave you a minute on this, but all right. So we got like 1 to 2K in the cash for keys, 1K. So here's what I did. So I offered 2,000 in cash for keys. You know, and going in, I figured they're probably not going to want to do cash for keys anyways. Although if they did, given the BPO value, I could easily do 10,000 plus. But rather than open up with some large number like that, I just put out, you know, a number that might kind of entice them to think about it. There's a good starting point in case they really want more money. I'm not opening super high just in case they would accept something that was smaller. And then for the forbearance trial payment plan mod, asked for a $2,000 good faith down payment and then 12 trial payments of $600 a month, and then moving the arrearages to the back of the loan. So the $2,000 good faith down payment is higher than what I normally do. Usually I'm asking for 1,000 or sometimes 1,500. But because the foreclosure scenario was, there's so much equity in it, I was comfortable doing that. You can always, you know, if there's something else going on, you can always talk more about that later. So that's what I went in with. And then we get into what has actually happened. So they actually came back right away and said they accepted the $2,000 cash for keys, which I did not expect at all. Sometimes you get surprised. I shouldn't be, but you know, sometimes I get surprised by different things in this business. And this is actually one that's happening real time. So the move out is actually scheduled for tomorrow. So we've been putting that together. I've got a pretty good REO vendor there who's got things, you know, who had things coordinated with the borrower about a week and a half ago. The one wrinkle was so on October 16th, I got a letter in the mail from the city that said the letter was dated the 4th, and it said that there are code violations and there's trash in the yard and it's blowing into the neighbor's yard. And if you don't have it cleaned out by the 14th, then they could press like misdemeanor charges against me and put a warrant out for my arrest potentially. Of course, I didn't get this till the 16th. So I called the city. And it turns out this borrower was actually one of the city's like code problem children. They've had a lot of issues with trash and different things at the house. So the lady at the code enforcement was really happy to hear that he was moving. Although it's kind of funny, she was interested in where he was moving to because as far as I'm concerned, he's going to be out and be gone and out of my life. But for the city, he may pop up somewhere else in town. But the city was actually good to work with because I called them and, you know, we coordinated getting a dumpster out there early so the guy could start moving his stuff out. So hopefully all goes well with that. Tomorrow, that was kind of a nice surprise. I did not expect that. I was expecting some kind of forbearance agreement, but you never know. All right, case 2. So this one's in Shelby, Ohio. So this note picking up for $12,000. A little under 23,000 unpaid balance. This was, a little more than 50 cents on the dollar. Loan payoff 29.2, so quite a bit of arrearages for considering the small balance. This one also had $1,781 in delinquent taxes, and my BPO estimate had a $50,000 quick sale value and then a $60,000 90 to 120 day list. Shelby is kind of a smaller town. I forget exactly how big it is, so that's probably why you get some of this disparity in the BPO. Next due was back in May, and I bought this in August of 2019, I believe, so about 2.5 years behind at the time. 4 payments in the last 12, so not too bad, and last paid about 3 months before I bought it. So again, kind of basically the same exits. Now this one would be a forfeiture. It's in Ohio, but the contract for deed was written in, I believe, 2016. So if I do have to go to that, I can do the forfeiture process, which is similar to the foreclosure. It's basically faster. Should only be a couple months, less expensive. You might be spending, I think the last one I did in Ohio, I spent only about $2,000 versus $5,000 or $6,000 for a foreclosure. And with the forfeiture, there is no sheriff's auction. So on a forfeiture, the land contract gets canceled. If you have to, you get the borrower evicted, and then you have the property, so you retain any equity that's there. So forfeitures are nice if they're a possibility. Cash for keys, and then same forbearance agreement. So in this one, I was assuming a 12-month timeline. I knocked a couple months off because we would be able to do forfeiture instead of foreclosure. Note price of $12,000, and then legal fees, clean out, due diligence, servicing of $9,000 altogether. Basically, that's a little less than the other one because I'm going to have fewer legal costs with the forfeiture. And again, I try to be conservative with the clean out costs and all that because I just always seem to get surprised. And then I'm assuming the proceeds from the sale would be about $40,000. So my 30-day quick sale BPO was 50, but I always knock that down by at least 10%. So I'm assuming 45. Wouldn't even hurt to assume 40. And then about 10% selling costs, I'm assuming I'll net 40. And this ROI comes out very high. That's kind of unusual. Usually the forfeiture ROI isn't that high. So this was pretty good. The one rub is it's a little smaller town, so that might make it a little trickier to capture the full 40,000. However, there's a lot of meat on the bone on this one, so I'd have wiggle room to just get it sold if I have to. All right, so cash for keys options. Now the BPO value is 50. We're going to be into the note for 12, so I'll open it up again. What would you guys offer for this one? Give you guys just a minute. 1,000 again. All right, sorry, next time I do this, I'll have the polls set up ahead of time. I meant to do that earlier today and I didn't get to it. All right, and then the forbearance trial payment plan. So again, unpaid balance a little under 23. P&I is pretty low on this one at 230. So we'll be looking at for good faith down payment, trial payments, and trial payment amount. Basically on the trial payment amount, so option A, 230 would be just the P&I. B, the 375 would basically be the P&I plus escrow. 500 is just kind of a nice number for a trial payment plan. Usually if you go a little higher, you're recapturing some of the arrearages, and then you can go really high if you want. All right, so I'm still thinking about that. Here's what actually happened. So I actually didn't get that whole battle plan put together. One of the things that I do, well, let me back up. So the borrower called me directly before the loss mitigation even started. So one of the things I do when I buy a loan, typically at least a non-performing loan, there will be hello, goodbye letters that go out from the loan servicers, but I will send out my own hello letter that has my contact information, and ask them to call. It basically says, hey, that, you know, you're behind on your loan. We really want to talk to you so we can work something out. And I got that letter to the borrower. And this is normally what happens. The letter beat the borrower before the loss mitigation folks did. It's interesting. Most of the time, borrowers don't call me right away, but sometimes they do. And this is one where they did. So she called me, and she said that they had some homeless friends that were staying with them for a while earlier this year, and that the homeless friends brought bed bugs with them, and they had a bed bug infestation. And then she had to hire 2 different exterminators to get rid of the bed bugs because the first exterminator didn't work. And that's why there were no payments between May and September, because they were spending all the money on bed bug exterminators because of these homeless friends who brought them in. She also said she has 7 kids. And the borrower says, well, your letter said, you know, to call you, so I did. Now what do you say? And realize too, right, this call comes in, I'm not expecting it. And I have a lot of loans, so like this particular one, I'm like, give me a second, let me pull up some of the data so I can even see the specifics. So, you know, any thoughts from you guys on what you say to the borrower at this point? This is one of those examples where, you know, all the pre-planning kind of goes out the window a little bit. But actually this one caught me because I hadn't done the pre-planning yet. All right. So here's what I did. So she definitely wanted to stay, offered a $500 good faith down payment, and then 12 trial payments of $500, and then move the arrearages back to the back of the loan and extend the term. Borrower agreed, and I wrote up the forbearance agreement, sent it out. She signed it and got it back. You know, and it was interesting too, because I think her story was real, but if she was making up the bed bugs and the 7 kids, that was a genius move, because it was making me really not wanna it was making the forfeiture option look less good. However, she did sign and return the forbearance agreement, but then hasn't made any payments. So I actually had Polaris get a hold of her later. They've been talking. Ended up finding out she couldn't really afford the $500, so we agreed to make it $375, but still haven't seen a payment. So this one is off to a rough start, and I have a feeling this is going to end up being a forfeiture. So if anybody wants a bed bug house in Shelby, Ohio, I'll probably have one in a couple months, but who knows? Hopefully she comes through. And that's a pretty common thing where borrowers, you know, make an agreement and don't follow through at all. I mean, in this case, she never sent in the good faith down payment. So that happens. We'll see how it goes. It's not quite over yet. There's still a chance to get it on track, but not looking real good. Okay, so this third one was in Norwalk, Ohio. Kind of nice little town. I've been through here before, and I've walked through this neighborhood in front of the house and everything. So pick this note up for $13,450, unpaid balance of almost 30, so a little under 50 cents on the dollar. They're about 4K in arrears. The P&I is 419, which is nice. That's a healthier P&I. The 30-day quick sale BPO value was 40. So they were only 10 payments behind, and they had made 8 payments in the last 12. So this was one of those where, you know, I thought it had a really good chance to reperform. So this one would be a foreclosure because it's a contract for deed. It was over 5 years old in Ohio. And then we'll look at the deed in lieu and forbearance agreements. So, you know, I'm assuming, I'd assume 15-month timeline on this one, 2 months for loan boarding, 3 for loss met, 7 for foreclosure, 3 to evict. This one, I believe, did have a loan transfer required. That's why I had a little more time in here for the loan boarding. Legal fees, clean out, taxes, etc. Assuming about 11,000, so about 24,450. And then I was assuming that basically I would net 80% of the quick sale BPO value. So figure, you know, you sell it for 90% of the quick sale BPO value and then have about 10% selling cost. That's a quick kind of back of the envelope way to do it. So this comes out to a total of 32% ROI, 16% to the JV partner. That's thinner than I would like on a foreclosure, and as you can see, it was thinner than the other ones. But the main difference between this one and the other ones is I was okay with this because it had 8 payments out of 12, and I know there's a very high chance of getting it to reperform. I got to put together some more detailed statistics on my portfolio, but overall, if I buy loans with signs of life in them, I'm getting them to reperform about 2/3 of the time overall. And this one had more signs of life than most, so I know there's probably a good 80% plus chance, of getting this one to reperform. So cash for keys options, so BPO value of 40, note price of 13,450, so a little lower value property here. Borrower's got a little bit of equity. So what do you guys think about this one? All right. And then when we do and then what do you guys think about the forbearance plan? So good faith down payment, number of trial payments, and then trial payment amount. All right, so here's what I did. So I actually didn't bother to offer cash for keys because I figured this was one I did over a year ago. I figured the borrower had equity. There was no reason to do it. I've kind of learned since then, it doesn't hurt to offer just because sometimes borrowers take it, like in the case one for Ashtabula that we had. For the forbearance agreement, I wanted $2,000 good faith down payment, 6 trial payments of $419 a month, and then move arrearages to the rear of the loan. If I had this to do over, I would have offered a cash for keys. I would have asked for a smaller good faith down payment because it's kind of a smaller loan, smaller property value. And I would have asked for larger trial payments that covered in escrow for taxes and insurance. So it's one thing I would change from this. And so what happened was this one got kind of interesting. So initially the borrower engaged with the borrower outreach team with Polaris and sounded like she wanted to put a forbearance agreement in place and thought we were making progress. And then she went dark on them and just wasn't responding at all, just quit. I thought, oh crap, I'm actually going to have to go through the foreclosure on this one, which I was annoyed with because I really didn't expect it. It's funny, I don't mind going through foreclosures, but I get annoyed when stuff happens that I really didn't expect to happen. I'm not sure what that is, but so we sent a door knocker with a letter, and this letter I wrote said that you know, in a nice but kind of firm way, that we're willing to work with her, but if we don't hear from her, we're going to start foreclosure, and then that's it. And this was one of those I had mentioned earlier where this loan had been traded a couple of times, and you know, Polaris even came back and said, I think maybe she thinks that if she talks a little bit and then goes dark, you'll just kind of give up and sell the loan. And so I tried to word the letter so that, and they even said kind of explicitly, look, we understand this loan's been traded. We understand a lot of people will resell the loan if they can't collect, but Fusion Notes is different. We don't do that. We'll do everything we can to work with you. However, if we can't, we are going to foreclose and take the property back. That's it. And then the borrower called her back like the next day. So I had this hand delivered with a door knocker. That got her back in the ball game. So she ended up signing a forbearance agreement with $1,000 down payment, which was a little less than what I wanted, but not bad. And then the 6 trial payments of $419. And she followed through with the agreement, and then, you know, continued to make payments, processed the loan mod, and, you know, she kept up with the taxes and insurance and everything, and then resold this as a reperforming loan about a month or two ago. And the annualized, I forget what the actual the raw return was, but the annualized return to the JV partner was 15.1%, so about 30% return overall. And that's pretty typical for a contract for deed that you get reperforming and then sell. You know, in some cases that 15% is lower than like what I call the novelty returns you can get sometimes when they take the property back and things work out well. but it's kind of nice because you're getting payments as this goes along, and the outcome is kind of predictable. And from my standpoint, there's a lot less brain damage just managing loans versus managing REOs. So this one turned out pretty good. So that's what I got for you guys tonight. I can stick around for a few more minutes if you guys get any questions, anything you want to, you put it in the chat box, or you can raise your hand if you want to come on and speak. Can unmute you and do that as well. But otherwise, thanks a lot for your time and tuning in. Really appreciate it. Plan on doing more of these in the coming months. And also let me know too if there are any other subjects that you want to hear about. I like to try to cover some of the subjects that don't get talked about as much. So we got one question. So are you using a servicer for these workouts? I don't. I have tried that before. I use a company called Polaris Counselors, and actually I don't know if they're accepting new clients anymore. What I like about them is they're actually a nonprofit, and they're credit counselors. So what's really good about them when they reach out to the borrower, because they're really more credit counselors than debt collectors, it's kind of a softer approach. And they're really good at talking to the borrowers and understanding their situation and helping put together a deal that not only works for me, but that they'll be able to afford to follow through on. One of the things that can happen, and actually I bought a loan where I inherited a forbearance plan like this, where I bought a loan one time and inherited a forbearance plan that had a trial payments of $750 a month. And then the borrower stopped performing on that and found out that they could in no way perform that. But when they were approached with that deal, they were kind of scared, didn't want to lose their house. So they just said, okay. But it really doesn't do anybody any good if you scare a borrower into, agreeing to some kind of deal that they can't follow through on. I've had players come back with some too, where, I've asked for a high good faith down payment and they've negotiated me down. They come back and say, look, I know you asked for $2,000, but I don't think there's any way they can do that, but I think they're sincere about wanting to stay in their house. So, we could do something like this. I think this would work. And then a lot of times I'll go with that. If you do use a servicer, probably most people use servicers, just stay on top of them. My one experience with a servicer where I let them do that a little bit was just not good. And I don't know if it was just the particular asset manager I had there. And this was not Madison or Allied, by the way, this was somebody else, but they would literally make like one phone call a month and then say, oh, we didn't get them. And then make another phone call the next month and then charge me like $81. It was not a good situation. So another question here, what percentage of UPB are you seeing on the sale of a reperforming note in the under 50K range? It varies. It really, they're going kind of anywhere. I'd say one thing in general, I don't know if there's really such a thing as like market pricing in notes, because I see wide ranges. Like I've had, some sellers that want crazy high prices for things. And then in other times I've had bids get accepted that I didn't think would get accepted. But in general, probably 65 to 80%. That'll vary based on how much equity there is in it. And then it can also vary based on if you're buying, a batch of notes versus one at a time. Usually one at a time. Sellers want more. If you can, work out a deal where you're buying a handful of notes, you can often work out a better deal. But I would say if I had to guess, like, 65 to 80 overall, probably in the low mid 70s is kind of typical, but mileage varies. So it's hard to come up with hard and fast numbers. So there's a question about the cost of Polaris. So they're, like I said, I don't know if they're even taking new clients, but there's I think it's $100 or $150 to board I think it's $100 to board the loan with them, and then like $150 a month. But it's very good for me because usually they drive it to a conclusion within 2 months. So I generally budget on average about $500 for them, and they like pretty much always spend less. And they're pretty good too. If they can't get a hold of the borrower, or if they do get a hold of the borrower, sometimes it's funny. They deal with so many borrowers. They're really good at reading the situation, and so you know, sometimes they come back and say, hey, we talked to the borrower and this is what they said. And I think they're really sincere. They're usually right about that. Sometimes they come back and say, well, I talked to the borrower, but I don't know. You know, I don't know how straightforward they were being with me. So, yeah, I mean, it can be kind of pricey, but they move fast and they move the deal fast. And because what I like to either do is, you know, I like to get through the loss mitigation as quick as I can and either get it reperforming or start legal, because legal takes a long time. So I want to start the clock on that as soon as I can. One of the things I've considered is just starting legal right away as like a forcing function, but you know, you also end up spending a lot of money if you do that. And I hate to start and stop legal because that gets expensive. So it's tough. Mileage varies. I mean, one of the things I've been kind of focused on lately is trying to tighten up the timeline on the deal, because I've done some playing around. I mentioned the XIRR return on that last one. It's really amazing how through like the loan transfer, the loss mitigation process, or you know, just in legal, if you know, when an attorney sits on something for a few weeks, like you can lose a month here and lose a month there really quick, and that adds up and that really impacts your annualized returns. So I've been trying to think about what I can do to be a little bit more efficient and tighten up the timeline. Okay, so I think that's about it for questions. So thanks everyone for joining. Really appreciate it. I will post replays of this later on, and I will see you next time.